Thank you, everyone, once again. My name is Oje Samuel. Thank you for being here, joining me for my 45th birthday anniversary. And I'm marking that with this lecture on the National Tax Bill, the transmitted National Tax Bills, the potential financial reporting implications. When we say transmitted, the transmitted could come from various ways. From the first time the bills are initiated by the president, the process of sending those bills to the National Assembly is transmission. Now, when the House of Representatives and Senate separately worked on the bills, coming up with potential amendments, then they went ahead to set up a committee to unify the recommended amendments to those bills. The finalized version of that bill was sent to the presidency. So that process of sending the finalized version of the passed bill to the presidency is also transmission. So transmission could be two-way. The process of sending information formally from the presidency to the National Assembly is transmission. And also the process of having done the job, so to speak, or having finalized the bill's review and sending it back to the presidency is also transmission. So the transmission we're talking about here is that transmission that focuses on the finalized bill by both arms of the National Assembly that have been sent to the presidency, awaiting its assent. And constitutionally, we are aware that the assenting to be done within 90 days. So that also it is that version of the bill that we are dealing with. We are not dealing with the original bill as developed by the Fifth School, the Fiscal and National Tax Reform Committee, headed by Mr. Taiwo Oyedele. We are not dealing with that version. We are dealing with the finalized version because there are some changes, right? So that version we are dealing with. And also a quick touch on the topic again. We are saying the topic is potential financial reporting implications. Potential financial reporting implication. We are not dealing with the tax implication by way of compliance yet, because that would be too fast ahead of us. Why? Because when the bills are passed, the FRS or the NRS, National Revenue Service, that will come to be, they are going to come up with regulations. They are going to come up with circulars. They are going to come up with guides, how that law will be transited into. We are currently in a framework, right, containing various over 15 tax laws, or 12 or 15 laws that were repealed by the incoming national tax bills. So it is the NRS, National Revenue Service, hopefully, that will provide the transmission, the transition plan and other practical, execution procedure. So it will be too fast to jump into tax implication when we are not NRS, when we are not, Federal Ministry of Finance and other appropriate government agency that have input in various aspects of the new tax law. So what we're focusing on is on the potential financial reporting implications. And here is why. When we say potential financial reporting implication, given the nature of financial reporting, given the nature of corporate reporting, based on the laws that have been enacted or substantively enacted, as we always read in IAS 12, based on tax laws that have been enacted or that have been substantively enacted, the provisions of IFRS accounting standard concerning income taxes follow such enacted tax law or follow such substantively enacted tax law. So those potential financial reporting implications are our focus for this. So I'm going to proceed by sharing my presentation, and we'll go straight to the structure of financial statements. So we'll not be mentioning all the effect of the new tax bill, how revenue to be allocated, how VAT revenue to be allocated, what is the new tax rate, we are just going to go straight into how they impact on the typical set of financial statement that I'll prepare. So that is the focus. Within the next 2-3 hours, so based on the question that will be coming, we're going to deal with how they affect all of those things practically. We're going to see them, the way they are. So let me proceed to share the material, and then we take it straight forward from there. Thank you once again for joining me. It's my honor and pleasure to have us here. So if you look at the screen, you are going to see a Word document, the transmitted national tax bills, potential financial reporting implications. The transmitted national tax bill, potential financial reporting implications. Please, in case I'm not responding to your good messages on the chat, bear with me, right? It's a lecture, right? So I'm going to respond. I acknowledge all the good messages that have come in personally and on this chat, but we'll be dealing with what we have before us. So we are dealing with the potential financial reporting implication. So that is our focus. And there is no other way to do that other than looking at the structure of financial statements itself. Now, a quick straight to the point matter. Under the transmitted tax bill, we have two categories of companies. It is either you're a small company or a large company. We no longer have the concept of medium-sized companies. I repeat, it is either you're a large company or you are a small company. We no longer have the concept of a medium-sized company. Recall that the concept of a medium-sized company under our regime, current regime, started from Finance Act 2019, when you recall, where that window, there was a layered categorization of company. We have the small company, we have the medium-sized company, and then the large company. Small companies are those companies that are their gross turnover or annual turnover is not above 25 million. 25 million and below qualifies an entity as a small company. The medium-sized company are those companies whose turnover above 25 million, but less than 100 million. Medium size. That is still what we have as I speak with you. The filings we'll be doing for our year end, for June 30th, and all of that is still based on these categorizations. So medium-sized company turnover is above 25 million, but less than 100 million. Then for the large company, as we have, as incidental by Finance Act 2019, your turnover is 100 million and above. And the implication, under the current regime that we phased out when these tax bills are signed into law, the medium-sized company are taxed, their profit are taxed at 20%. The large company are taxed at 30% as usual, apart from other earmark taxes that we have, right? Like the tertiary education tax, NASENI levy, industrial development, information technology development levy, and Nigeria Police Trust Fund, and all of that. They are different, right? But 20% is the income tax rate for medium-sized company, 30% is for the large company. But this is what we are saying. Under these transmitted bills, when signed into law, in the form that they are, right? You know, there are 4 categories of bills there, but the one with the landmark impact on financial reporting is the National Tax Bill. We have the National Tax Bill as a bill. We have the National Tax Administration Bill, Tax Administration Bill as a bill, right? We have the Joint Revenue Board Bill, right? Yes. You know, that joint tax board, something like what you used to call the joint tax board, right? We have a bill for it. Then we have a bill, right, that replaces the FRS Establishment Act, which is now proposedly NRS, that is National Revenue Service Establishment Act. So therefore, one focusing on the core of the technicalities of the tax laws that we know in the compliance of taxation. That is the National Tax Bill. Then the National Tax Administration Bill deals with the administration, procedures, protocols. That is the second set of the bill. The third one is the one you can call, the one that deals with your current joint tax board, your tax appeals tribunal, and the new tax ombudsman. I hope that works in Nigeria. You know, we've always had the concept of ombudsman all over the world, and in other areas of life, even in Nigeria. We have legal ombudsman. We have a commission in Lagos called, what's the name of that agency? Public defenders, something for public defenders. Those are legal ombudsman, right? So we hope that the tax ombudsman, which is one of the 3 key components under that bill, we hope it really defends taxpayers. But let's leave that. That is not why we are here. Then the fourth one is the Nigeria Revenue Service, the Nigeria Revenue Service Establishment Act. So all these four bills, right? The National Tax Transformation. So somebody should stop, writing across my screen. Please stop writing across my screen. Watch your pen. It may be in error. So those are the four bills. Now, the one that focuses on the practicality of operational tax consultants, apart from the administrative wing, is the one dealing on national tax bill. So in that bill, you are either a small company or a large company. Simple. So the question is, what is a small company under that tax bill? What is a small company under that tax bill? So a company is small if its gross turnover is no more than 50 million naira. Recall that currently it is 25 million naira mark threshold. But if I use the word if that transmitted bill is signed in that form, the threshold for small company will become 50 million naira, no more 25 million naira. And therefore, any company whose turnover is above 50 million naira is a large company automatically under the incoming tax provision. Any company whose turnover is above 50 million automatically, irrespective of what you do, is a large company. That's what we are saying, is a large company. Now, and because it's a large company, it has an impact on the tax rates or the assessable profit or total income to be taxed. As a small company in Nigeria, as we have here, as we have currently, your profits are exempted from all forms of income taxes apart from CGT. As a small company, your profits, right, are exempted from income taxes apart from CGT. Because CGT is an income tax based on chargeable assets disposed and where capital gains are made, right? So, but if you're a small company, you are not subjected to any form of income taxes by way of company income tax, by way of tertiary education tax, by the way of NASENI, ITDVL, Nigerian Police Trust Fund, and the rest of those AMF taxes. So you're only subjected to those taxes if you are a medium-sized company or a large company in Nigeria. However, when or if these bills are signed in the way they are, Molester, can you please control your screen, your pen? You are adulterating our screen. You are adulterating our screen, please. We've left the joining in to be live brow to avoid them interruption of trying to admit or not to admit participants. That is why we are seeing this. We let the control loose. So please, Molester, kindly clean up what you've written across our screen. So we move on. Now, in the incoming tax bill, if you're a small company, of course, your income or profits are still not taxable. It remains as the same. The only thing that's happening is that we are going to have more companies coming within that net based on the 50 million naira turnover threshold. And any company that is not a small company is a large company. Now, it has an implication for any company that has before now been classified as a medium-sized company. It has an implication.
Question.
It has an implication. Pardon, did somebody say something? Okay, so it has an implication. This implication, if you are currently a small company, a medium-sized company, and your profit is taxable at 20%, the question is, what class of turnover makes you or has made you a small company? Recall, in the current regime, if your turnover is above 25 million, your income is taxable. It is either it is taxable as a large company or it is taxable as a medium-sized company. When it is taxable as a medium-sized company, that will mean your turnover is between above 25 million and 100 million. So this is it. If your turnover as a medium-sized company average between 25 million and below 50 million, that means you are going to be part of those medium-sized companies that now fall under the new categorization of a small company. I take it again. If you are currently a medium-sized company and your turnover is above 25 million, but no more than 50 million, that implies that you are going to be one of those medium-sized company that will now fall into the new categorization of a small company in the new regime. If you fall into the categorization of a small company, of course, you no longer pay company income tax or tertiary education tax. For that year of assessment, that your turnover remains so within 25 million and 50 million. However, if you are that medium-sized company currently, whose turnover is between 50 million and 100 million, automatically you are now a large company. So as a large company now, even though you were previously a medium-sized company, your profit becomes taxable at 30%, at 30%, no longer at 20%, 30%. Now let's recall, if you follow the bill before, when you read between section 56 down to 59, you notice that the fiscal committee recommended 25% for company income tax, if you recall. They recommended 25%, not 30, graduated for companies over a certain period. However, the National Assembly, thought, have a different view, that the 30% should be sustained, right? So the 25% you are seeing in any tax bill you are seeing, that was the version that went to the National Assembly. The harmonized version of the National Assembly and the House of Rep is 30% recommended. So we don't know what the presidency will do, but we think that will go the way it is, 30%. Therefore, back to where we are. If you are that small company, right, whose medium-sized threshold is above 50 million, right, is above 50 million, automatically, above 50 million and less than 100 million as of now, in the new regime, you become a large company and your profit is taxable at 30%. Let's take that away. That's number one. I want to stop this share and to reshare because of one of us that has stayed my screen. But I want to appeal, let's watch our pointer, our cursor, and our pen, because we don't know when they go around to disturb the surface of what we have here. So that is all about that. Now, in addition, we now have what we call development levy. It is not news, I'm sure we are all aware, but we are dealing with the reporting implication, right? We are dealing with the reporting implication. We now have what we call development levy. What is the meaning? Development levy has been introduced as a composite tax, income tax, that is a substitution for a collection of all those earmarked taxes. Question. Okay, go ahead, question. But later on, I'm going to take question at my appointed time. But question, go ahead quickly. Okay, if not, you are going to allow me when I'm done. I'm going to let us have time for question, right? You can drop it on the chat, right? So I'm going to allow time for question at the appointed time so that it doesn't interfere with our flow. So this is what we are saying. We have currently, not used to, currently, what remains till now is we have 3% for tertiary education tax. We have 1% for information technology development levy. We have now outstanding levy, 0.5%. We have information technology development levy. We have Nigerian Police Trust Fund, 0.005%. Now, these are various income taxes that have been put in place to enable the funding of critical infrastructures, whether it is educational, whether it is in the world of information technology, whether it is in the world of automobile, right, environmental protection, and also security. These are various earmarked taxes currently that we have. However, in the transmitted bill, we no longer have those earmarked taxes. We have a single tax called development levy. And that development levy is 4%. The development levy of 5% is not payable by a small company, it is payable by a large company. It is not payable by a small company, but it is payable by a large company. So let's take note. Development levy, 4%. So in addition to the current income tax of, a second please, I need to remove someone. Just a second, please. A second. Okay, so yes, so I wanted to avoid probably the person is not following what we are doing here. Okay, so permit me to reshare again. Okay, so we'll go on. Now, a development levy, as I was saying, is, a composite of all of those earmark taxes payable by a large company, not a small company. Payable by a large company, but not a small company. So we are set. We've set it out that we are not going to have, we currently have, but we are not going to have in the future, in the immediate future, medium-sized company. It is either a small company whose profits are exempted from income taxes, or you're either a large company whose profit is taxable at 30%. We will no longer have medium-sized company, and the implication is for a current medium-sized company, if your turnover is between 25 and 50 million, you are going to fall into the new future category of small company. Right? Yes, I've not moved the screen yet. So you are going to fall into the category of a small company. But if your turnover is above 50 million and below 100 million as medium size, you will fall automatically into the new categorization of all large company. And that will mean that as a large company, your company income tax rate is 30%, and your DV levy, development levy, is 4%. In total, you'll be paying a total of 34% of your profit. Let's take note, the development levy is levied on your assessable profit, But your 30%, of course, is based on your taxable or total profit. So the 4% is based on the assessable profit. The 30% is based on your total. It's based on your total. It's based on your total or taxable profit. Now let's move on. In line with the structure of a financial. Now, what is the typical structure of financial statement with respect to income tax information? We are not dealing with all the gamut, all of the areas of IFRS. No, we are dealing with that structure of financial statements that have something to do with income tax information. So what is the structure? What is the composition? What is the composition of a typical financial statement or a set of financial statements that have tax information? So generally, in your statement of financial position, what we used to call the balance sheet, in your statement of financial position, right? In your statement of financial position, what we have are 3 line items. You are more likely to see 3 line items. Number 1, you are going to say current tax payable line item, the one I'm highlighting right now, current tax payable line item, or current tax receivable line item, or even both current tax payable and current tax receivable line item. You are going to have that as a line item. You will have that. Number 2, you can have a deferred tax asset as a line item or a deferred tax liability. In a typical statement of financial position or balance sheet, these are the 3 line items you can have. Once again, you can have current tax payable or current tax receivable. It is also possible as an entity to have current tax payable reported separately as a line item and current tax receivable reported separately as another line item. Number 2, you can have either a deferred tax asset or a deferred tax liability if your financial statement is that of an individual or separate financial statement. I take it again. In the financial of an individual entity, you can have only one of either a deferred tax asset or a deferred tax liability, and not both. Because in individual financial statements or in separate financial statements, we report deferred tax position as a net position. We don't present deferred tax liability arising on some item as a line item separately from deferred tax assets arising on other items. So where you have a deferred tax liability balance on some items and a deferred tax asset balance on some item, you are required to present them as a net amount or as a net balance. In other words, only one item will appear in your statement of financial position either as a deferred tax asset or a deferred tax liability. However, I've said this is about individual or separate financial statements. We know we have financial prepared by a parent that includes all the assets and liabilities of his subsidiaries, right? And sub-subsidiaries, as the case may be. Therefore, in a consolidated financial statement, you can have deferred tax asset as a separate line item from deferred tax liability as another separate line item. It is only in a set of consolidated financial statements that you can have deferred tax assets as a separate line item, concurrently having deferred tax liability as a separate line item. This applies only when you prepare and present a consolidated financial statement. And here is the reason. When you consolidate your subsidiary or your subsidiaries, when you have two or more subsidiaries, it is possible that the deferred tax position of one of the subsidiaries may be a net deferred tax liability position. I take it again. When you have two subsidiaries, it is possible that the deferred tax position of one of the subsidiaries may be a net deferred tax liability position. Net deferred tax liability position. For the other subsidiary, you may have a net deferred tax asset position. Therefore, two subsidiaries, one has a deferred tax asset net balance, the other has a deferred tax liability net balance. When you are consolidating, you are not allowed to present them nets unless you're in a country where group tax filing is practiced, e.g., United States, e.g., Canada. They do group tax filing in the US and in Canada. So if you're a parent presenting a consolidated financial statement and you're in a tax jurisdiction, you're in a tax arena reporting environment where group tax filing is done, you are allowed to net the different deferred tax position of your subsidiaries. In other words, where a subsidiary has a deferred subsidiary A, for instance, has a deferred tax asset balance of 2 million. Subsidiary B has a deferred tax liability. One has an asset balance of 2 million. One has a liability balance of 3 million. When you net an asset of 2 million with a liability of 3 million, you have a 1 million liability, net deferred tax liability balance of 1 million. You are allowed to present as a one item net deferred tax liability 1 million in your consolidated financial statements. You do that only when you are in an environment where there is group tax filing. However, in Nigeria, we do not do group tax filing. Therefore, for every consolidated financial statements in Nigeria, you are required to present the alternate deferred tax position of your subsidiaries separately. If subsidiary A has a net deferred tax asset balance of 5 million, and subsidiary B has a net deferred tax liability balance of 3 million, present the deferred tax asset balance alongside with the assets of that consolidation. Present the deferred tax liability balance alongside the liability component of that consolidation. That is what is done in Nigeria. Now, we are done with highlighting the three components you see in a typical statement of financial position in Nigeria. The point is, what is the impact of the transmitted national tax bill if signed into law in the version that it is currently in? We're going to talk more on that as we move, a lot to say, as we move down along the way. Let's go to the presentation. Look at your typical statement of financial position. Look at the screen, colleagues. We are going to say typical statement of financial position presented using the current non-current method, right? Current non-current method. Now, looking at this, I want us to isolate, right, the various tax line item information contained in this hypothetical statement of financial position. So I will scroll under non-current assets. We don't have anything here that is tax information related. Under current assets, we do not have anything here. Under current liability, we have something there. We can see current tax payable. Current tax payable. So this, I'm starting with another practical implication. Going forward, if you are one of those medium-sized companies whose turnover is between 25 million and 50 million, after clearing, I repeat, after clearing any arrears of your tax liability, and you remain within that threshold of between 25 million and 50 million as turnover, right? You know, I had said that you have automatically become a small company. Therefore, income tax will no longer be payable by you. So, any medium-sized company that does not have any arrears and obligation of current tax to be paid, and whose turnover is between 25 million and 50 million, that has become a small company, will no longer have a line item presented as current tax payable. I repeat, any medium-sized company that does not have an arrears of income tax liability obligation and whose turnover is between 50 million and is between 25 million and 50 million, that medium-sized company becomes a small company, and therefore its income is no longer subjected to company income tax or any form of development levy. And thus, no line item called current tax payable will be visible or seen in the statement of financial position. Let's take let's take it, that is what it is. However, there's a caveat. What arises when an entity has made a chargeable gain, a chargeable asset, has made a disposal of a chargeable asset, and is yet to remit? Recall, under Finance Act 2020, right, 2022, and when you make a chargeable disposal, you are required to make payment for that disposal. If that chargeable asset disposal occurred between January and June, right, you are required to have make payments from that CGT implication on the June 30th of that year. When a chargeable item disposal arises between July 1 and December, you are required to have made payment and remittance by December 31. That is the provision of the Finance Act. Therefore, even though I have said that a current medium-sized company with no outstanding income tax obligation and whose turnover is between 25 million and 50 million will no longer have current tax payable as a line item on the account of it being exempted from income tax as a small company. If there is a chargeable gain tax yet to be remitted, that will constitute the only item within current tax payable. In other words, where there's an outstanding remittance or liability arising on a chargeable asset disposal by a small company, that chargeable gain tax liability can only be the component of any current tax payable line item you see going forward in the new regime for a small company. But if an entity does not have a chargeable gain tax liability, and that entity does not have any outstanding income tax obligation from this regime into the new tax regime, that line item, current tax payable, ceases to exist. So let's take note of the practical implication. That line item ceases to exist automatically. Let's take note. Now, let me take it further. I want to take it further. Now, picture a scenario where in 2026 tax year or year of assessment, or in 2027 in 2026 accounting year end, for 2026 accounting year end, recall, because it is likely, I do not know, it is likely that the new tax regime will take effect of 2026. It is most likely. We're already in June. It is more likely. I do not know. It could be, from retrospectively from the current year and all of that. But for sanity of application, it is best it starts in the next fiscal year. But if I'm going to, if you are preparing a financial for 2026, recall, financial for 2026, or let me even assume that this new tax law come into effect immediately, yes, to simplify it. If you are preparing a financial for 2025, recall, you are going to have 2025 as the current year, you are going to have 2024 as the comparative year. Even though I have said that if you're a medium-sized company that has now come to fall under a small company categorization, that this word, this line item, current tax payable, will no longer be found. But if you're preparing for the first time in 2025, the comparative remains 2024, and recall, in 2024, you used to have current tax payable. What will happen is, under the 2025 column is going to be a dash, that is if you do not have outstanding income tax obligation, number one. It's going to be a dash if you do not have an unremitted chargeable gain tax liability, right? It's going to be a dash, nil. However, for the comparative year following it, it will not be a dash. Why? Because in 2024, you had current tax payable. That is going to be the structure or outlook going forward. If this tax bill, right? When I use the word tax bill, I mean the bill dealing with the tax bill itself, because we have tax administration bill, we have tax bill, we have NSR Establishment Act, but all of them, we call them, tax reform bills, all of them. But specifically, it is the tax bill, not tax administration. The tax bill, and it's the largest, the most voluminous, right? Over 200 pages. So that tax bill, what did they actually do? If you've gone through it, is a consolidation of PITA, CETA, value added tax, CGT, some area of hydrocarbon tax. That is a consolidation of all of these income taxes into one document, simplified, right? That is what it is. You have gone through it. That is what it is. Now, there's my point. My point is, please, in 2025, if those laws become applicable for a medium-sized company that now qualifies as a small company, for the 2025 accounting year, there will not be a line item, there will not be a figure under current tax payable. Why? Because if the entity does not have an outstanding income tax liability, if the entity does not have a chargeable gain tax yet to be liquidated or paid off, right, there will be nothing, dash. However, for the comparative year in 2024, you are still going to have an amount because there was current tax element as for 2024. That will be the presentational implication for a first-time preparer, right, or filer of IFRS financial statements. But in the following year, maybe in 2026, 2027, we are not going to see any line item at all called current tax payable. No. Someone may ask me, what happens if you have done a withholding tax? You have withheld a tax, you have done a withholding tax deduction from payment to your counterparties. Is that not the current tax payable? You have withheld, but you've not remitted. Right? You have withheld. The following one has gone. 21 have gone, you have not remitted. 30 have gone, you've not remitted. That is it not the current tax payable? Please, no. Withholding tax deduction yet to be remitted is not classified as the current tax payable. I repeat. Withholding tax deduction not yet remitted is not presented as the current tax payable. Why? When you go to paragraph 2 of IAS 12, IAS 12 paragraph is very clear. Income taxes are all those taxes based on the income, gains, and profit of the reporting entity. Question. I repeat. Question, Mr. Molester, why are you obscuring our screen, please? Why? Are you doing it intentionally? Do you have a question? Please go ahead with the question, please.
Yeah, what time is this finish?
Go ahead, you have a question. Go ahead with your question.
Yeah, what time does this finish?
12. Okay, we're going to go ahead. Let's go ahead. Okay, so thank you. We move on. So this is what I'm saying, right? So in the following year, there will not be anything called line item. I was talking about withholding tax deduction. The withholding tax you must have deducted is not based on your own income or profit. Please take note. It is based on what is an income of your counterparty, right? Or your supplier of goods or services. That is the meaning. So in that case, what do you do? What do you do in that case? In that case, you have to present it as part of your order payable. Please, withholding tax deduction, right? Withholding tax deduction without no remitted, and value-added tax payable. And value-added tax payable will arise where your output tax is more than your input tax. Please, all payables arising from withholding tax deduction by you, not yet remitted, and your value-added tax payable are not presented as current tax payable. No, they are not. They are presented as part of the component of your other payables. Let's take note. They are presented as part of the component of your other payables. So please don't say withholding tax not remitted, VAT not yet paid, and all of that. They form part of it. No, they are not, because current tax is based on income, gain, profit of the reporting entity, not the income gain profit of other entity. Let's take note. So that is that on current tax payable. Let's take note. Therefore, for a medium-sized company that has now become a small company, this line item will cease to exist if their medium-sized company does not have an outstanding income tax obligation, one, and does not have a chargeable gain tax not remitted within the reporting period. But as a first-time transitor, as a first-time reporter, in the current year, you are not going to see any figure or balance or amount for a medium-sized company. But for the comparative year, you are still going to have a figure, because in that comparative period, there used to be income tax payable by that entity when it was a medium-sized company. But for subsequent reporting periods beyond the phase of reporting, no single line item called current tax payable will be found in the financial of a medium-sized company. Of course, that presumes that we know that for a small company currently, right, or in the future, the line item current tax payable does not apply in any way. Yeah, that presumes we know about that. Yes. So
sorry, OJ, just a minute. Now, if there is a tax audit by the Federal Land Revenue Service, and now they are now bringing an assessment for a small company, they are bringing an assessment of tax liability in respect of previous years. So will it not fall under this current tax payable on the balance sheet?
okay, so I'm going to answer you later on, please. Let me answer you later on, right? So when I'm going to take audio responses, I'm going to, I'll deal with that. I'll deal with that, sir. I'll deal with that.
Yeah, can we speed this up, please?
Pardon? Okay, so we'll move on. We'll move on. Now, let me talk at the flip side. Current tax receivable. What is the position on current tax receivable? Current tax receivable can be found in the book of any entity. Current tax receivable can be found in the book of any entity. There are certain taxes to be received, but we must differentiate, please. Differentiate, please. If you have a value-added tax, if you have a value-added tax recoverable or recoupable. I repeat, if you have a value that are recoupable or recoverable, please, is not presented as an item within current tax receivable. If you have an item, right, as a VAT recoupable, VAT recoverable, in that sense, please, it is not presented as a current tax receivable. Current tax as an expression in IFRS is used for those in pertaining your income, gains, and profits. Therefore, VAT recoupable, VAT recoverable, VAT credit, whatever nomenclature it is called, is presented as part of your other receivable. It is presented as part of other receivable. That is that about that. Very key. Very key. So we'll move on. So this is the current part. Now we'll now go to the other part, which is the non-current portion. If you look at this, under non-current liability, you are going to see a deferred tax. Deferred tax. There's a question here. Deferred tax currently, I repeat, deferred tax currently is not presented in the book of any entity whose profit or income is not subject to income tax. Therefore, for a small company, deferred tax is not presented in its statement of financial position. Why? Because all small companies are exempted from profit tax in Nigeria. Yes. So let's take note. So all small companies currently are exempted from profit or income tax, apart from tax arising on chargeable gain. You know, I keep singling that out as a separate tax base. Where an income tax does not arise from chargeable asset disposal, deferred tax is not recognized, is not measured, is not presented in the financial of an entity that is a small company. So let's take note. So that is how it is done. That's how it is done. Let's take note. Now, let's come to a medium-sized company typically. Let's come to a medium-sized company. In a medium-sized company that has now become a small company, the question is, remember I said, currently for a small company, deferred tax item is not presented. Or if you are currently a medium-sized company, deferred tax is presented in your financial. For those medium-sized companies that will become small company in the new regime, I hope you are following me. For those medium-sized companies that will become small company, what happens to the deferred tax position they currently carry?
Can I get it higher?
Please, can we remove these Leicester something that
Yeah,
is just disturbing?
I have. It's a troll. You know, it's a troll. I have. Okay, so now, those medium-sized company that currently pay taxes, right, and have deferred tax balance, when they now become small company, what happens to them? So this is it. Let's take it. For a current medium-sized company that becomes a small company in the new transition, in the new era, we have to do what? Reverse the deferred tax balance or balances. We don't keep it. We don't keep it and await the future. We reverse it. That means what? In the first financial year, you'll be complying with the future tax bill. The deferred tax balance there will reverse totally. What do I mean it will reverse totally? If you have a deferred tax asset balance at the beginning of that period, in the financial we're preparing at the end of that period, you are going to credit that deferred tax assets and debit your income tax expense with the amount. I repeat, when you have a deferred tax asset balance at the start of a period, and you are now applying what is going to become the new national tax law, right? That deferred tax asset balance will have to be reversed. We have to be reversed. Why? Because the entity that used to be a medium-sized company and taxable is now a small company and thus no longer taxable. So we're going to reverse it. If you have a deferred tax asset balance and used to be a medium-sized company and you are now a small company, you are going to reverse it. And that will mean, what is the position of your deferred tax balance? Where is the deferred tax asset? You are going to credit your deferred tax asset account and debit your income tax expense. That is what you're going to do. Please don't reverse it to return earnings. Do not reverse it to return earnings. No, not return earnings. You are going to reverse it by crediting the deferred tax assets and debiting income tax expense. Where the balance is a deferred tax liability, you do the same thing, reverse it. In other words, we will no longer see deferred tax balance in your financial going forward, even though it used to be in your financial. Even though it used to be in your financial, we are not going to see that again in any form. That's what we are saying. We won't see that again in any form. At a higher level, we may need to know the item that make up your deferred tax balance. Because deferred tax is a sort of components. At that higher level, when we know the components, some portion of your deferred tax, depending on the stage of reporting you are, this is what I mean. Did the deferred tax arise in the first quarter of the period? Did it arise in the second quarter? Did it arise in the third quarter? Where the deferred tax balance arose in the first quarter, or second quarter, or third quarter, and you're preparing an interim reporting, that deferred tax balance will have to be reversed through income tax expense, as I've said.
Yeah.
So that deferred tax expense is going to be reversed, right? As I said, in that way. However, now let's take another scenario. If your deferred tax is a long existing balance, right? A long existing balance that has come over the years, please stay with me. That has, over the years, such components of that deferred tax balance can be reversed into your retained earnings. I want us to track a difference in what I'm saying. If the deferred tax balance is a component of an item that has been carried over the period into the current time, the reversal you have to do for that component of deferred tax will hit your retained earnings. It's going to be, let's assume that the deferred tax asset balance, right? And that component, the constituent of that deferred tax balance, is on an item that originated in prior periods. As it originated in prior periods, and you're about to reverse it, remember, because it originated in prior periods, the movement, either recovery or settlement in that deferred tax, had always dovetailed into retained earnings. When I say dovetail, it means that the movement in deferred tax as deferred tax income or expense that must have gone to your income statement constituted the component of your profit or loss for previous years that had gone into your retained earnings. Therefore, such components of the deferred tax balance is reversed between deferred tax account and retained earnings. So if that component is a 2 million naira and it's a deferred tax asset, we are going to credit deferred tax asset account and debit retained earnings. If it is a liability of 3 million, liability has a credit balance. It means we are going to debit deferred tax liability account and credit retained earning as a reversal of deferred tax, since the entity is now exempted from income or profit tax. However, if the component of the deferred tax arose within that reporting period, right? This is important for a quoted company because of ICFR, check. This is important for a quoted company. If the origination occurred within that year, in Q1, Q2, Q3, you are not doing a Q4 reportage or a full year reporting, you are going to reverse any existing deferred tax balance between deferred tax and income tax expense. Why? Because that deferred tax balance arose from within the year. That is what you should take note. But in summary, this is where we stand. In summary, this is where we stand. Where we stand is deferred tax as a line item will no longer apply in the book of an entity that used to be a medium-sized company, but is now a small company under the incoming tax law. That is the bottom line. That's what we are saying. But for those medium-sized companies whose turnover are still above 50 million, right? They are still taxable. But in the new tax law, not taxable as a medium size, but as just a large company. So for those medium-sized companies that do not drop into the small company categorization, they remain taxable. Therefore, whatever it is that they have as current tax payable remains. Whatever it is that they have as a deferred tax balance remains. Nothing is done. The only one that are affected are those ones that used to be medium-sized companies that are now small companies. Let's take note. Meaning we need to be sensitive to all those entities whose turnover have been above 25 million but below 100 million under the current regime. So those, are you of that company, or is your clientele base, component, having any of these kind of entities whose turnover are between over 50 million and less than 100 million? That is what to do about that on deferred tax. For a large company, nothing has changed. I repeat, for a large company, nothing has changed. We're going to get to the area where something has changed for a large company, but not in a quantitative sense per se, right? Apart from the development levy and the wording of accounting policy on income taxes, the presentation, the recognition, right, and presentation and classification of deferred tax is unaffected for a large company. The bulk of the effect is for those medium-sized companies that are now, for those medium-sized companies that are, a second place, okay, sorry, I need to attend to something. Thank you. So please, so the bulk of the effect is on those medium-sized entities, right? The small companies are not affected. Those companies that are currently small companies are not affected. So that is that about that. Now we move on. What we've done is the presentation of income tax information in the statement of financial position, right? Under the current, non-current method of a balance sheet, so to speak, right? We know it is called SFP now. Now, if you look at the other approach of presentation, which is the liquidity method of presentation, it does not affect anything. The quantitative effects arising from recognition and measurement is the same. Whether you are doing current or non-current, no effect. Do not bother. Do not bother. So, do not bother, right? So this is just to show you the other approach to we present statement of financial position. That does not affect. So we are done with the statement of financial position. So go to the next one, which is on the structure of income tax information, right? In statement of comprehensive income. Now, for the presentation or classification of income tax information, how are these new tax bills going to have effect on the line item? That's what we're saying. So if you look at your screen now, we are seeing a typical structure. We are seeing a typical structure of a statement of comprehensive income. A bolded one, look at it. This tax information, yes, this tax information, the one I've highlighted now, that is the line item relevant for our analysis. Now, looking at this, tax expense / income. This tax expense / income is a combination of your current tax movement and your deferred tax movement. The tax expense or income line item is a combination of your current tax movement and your deferred tax movement for that period in focus. So that is it for that period in focus. So the question is, if the new tax laws, these new bills, when they come into law, how does it affect the current categories of companies? Let's start from the first one. A small company remains unaffected, except if that company has engaged in a chargeable asset disposal under CGT. Then I want to mention to us what is recommended. We are going to have a new CGT rate, that is no longer 10%. The new CGT rate will be 30%. 30%. Therefore, let's recall that capital gain tax is a component of income tax. Capital gain tax is a component of income tax, right? Because the income tax is, I've said, is a combination of your current tax movement and your deferred tax movement. Then your current tax movement is made up of your company income tax, tertiary education tax, information technology development levy, NASENI levy, Nigerian Police Trust Fund levy, right? And then your capital gain tax. These are, and also your cybersecurity levy, if you're in the banking sector, right? These are the components of current tax item. About 7 of them for the biggest of companies: cybersecurity levy, NASENI, and ITDV levy, right, do not apply to some companies. So what they're saying here, if a small company, ordinarily, tax expense line item will not appear in your financial. Why? Because you are exempted from profit tax. Except if that tax, that income tax, or arises on a chargeable gain disposal. When you make a capital gain on a chargeable asset disposal, where that arises, that is the only condition where you can see an income tax expense line item in the financial of a small company. But if there is no chargeable asset disposal that translates into capital gain, no line item, what I've highlighted that we are looking at, no line item as this will appear in the book of a small company at all. So let's step up into those entities that are medium-sized entities. Based on the first analysis that we did, if we recall, the first analysis before I took a break. In that analysis, we said, if you are that category of medium-sized company that is not a small company, what I've just said for the small company will apply to you. Therefore, for those medium-sized companies that will become small companies, tax expense line item will no longer appear for the current year. For the current year, will no longer apply unless the income tax arises on chargeable asset disposal on which capital gain has been made. And as I said, what has been recommended for CGT is no longer 10%. Let's remember, it's no longer 10%. It is now 30%. It is now 30%, no longer 10%. So that's the only condition where you can see this line item. But for those medium-sized companies whose turnover are still above 50 million, everything remains the same. This presentation remains the same for your clients, for your companies that are medium-sized companies and whose turnover are above 50 million. Everything remains the same in terms of this presentation. Let's take note. Then for large company, for presentation, everything stays the same. That is that with respect to the aspects of tax information presented within statement of comprehensive income. So we'll move ahead. Now we come to, let's take note. I want to make an emphasis. Look at this section. I want to highlight now. This is the other comprehensive income section. This is the other comprehensive income section in your statement of comprehensive income. We know that. Now let's take note of something here, please. There's a line item here called property revaluation gain. What we call revaluation surplus, right? Now, on this revaluation gain and other items here, tax expense may arise on them. But I want to focus on revaluation gain, the one that is specific. When you buy a non-current asset for a given amount and you're depreciating it over time, then subsequently there is a revaluation. In the revaluation, there are two possible implications. You may revalue a non-current item that the current value or the revalued amount will be more than not just the current amount, it may be more than the historical cost. Let me take a building, for example. A building was bought for 50 million and it's been depreciated over 50 years, right? Over 50 years. Meaning that 1 million is depreciated off that building every year. A building bought for 50 million, depreciated every year for 1 million. After 10 years, 10 million naira will have been depreciated from that building. Therefore, the current amount of that building will be 40 million. 50 million historical cost, less 10 million will give you a 40 million current amount. If a revaluation is done in that year, there are two implications. For a building with a current amount of 40 million that is revalued, the revalued amount may be 42 million. So obviously, you have a 2 million naira revaluation surplus. Fine. There's no issue about that. There's no issue about that. We have a revaluation surplus. There's a 2 million. What happens if the current amount of that building is revalued and the revalued amount is now 70 million? Current amount 40 million, revalued amount 70 million. You noted that the 30 million revaluation surplus, but for income tax reporting, we don't just stop there. We still need to do a differentiation. Recall, the historical cost of that building was 50 million. Current amount is 40 million. And the revaluation is now translated into 70 million. That means there are two components of the surplus. There's a component of the surplus that is between the historical cost and the current amount. For something bought for 50 million, with the current amount of 40 million, it was revalued to 70 million, meaning that there's an extra 20 million gain on top of the historical cost. I take it again. For a building bought for 50 million, depreciated to 40 million, and revalued into 70 million, it means there is a gain in excess of the historical cost, and that gain is 20 million. In other words, while the revaluation surplus is 30 million, there are two components of that revaluation surplus. While the revaluation surplus is 30 million, 70 minus 40, you have 30. There are two components of that 30 million. 20 million component of that 30 million is a capital gain, is a potential capital gain. Let's take notes. And the other 10 million naira is a potential balancing charge. Do you see the difference? Out of the 30 million, 10 million is a potential balancing charge. The other 20 million of the 30 million excess is a potential capital gains. Why am I analyzing this? When we do a revaluation, we need to be mindful. Does that revaluation translate into an excess above the historical cost? Where the revaluation translates into an excess, right, above the historical cost, that portion of the revaluation surplus will be multiplied by the capital gains tax rate to determine the deferred tax arising on that portion of the capital gain. Please, I want us to stay with me on this explanation. I said, whenever there's a revaluation surplus, ask yourself, that surplus, is it above the historical costs of that item revalued? If it is, the portion of that revaluation that is above the historical cost, that portion is a capital gain that will be subjected to capital gains. Therefore, deferred tax is calculated on that capital gain using the CGT rate. But the other portion that is a balancing charge, a potential balancing charge, because you've not disposed of the building. The other portion, which is the difference between the total cost and the current amount, right? That is a potential balancing charge, right? Will be multiplied by the company income tax rate of 30%. But this is the beautiful thing now. If this tax be signed into law, there is no longer difference between the company income tax rates and the revaluation and the capital gains tax rates. Yes. If these bills are signed the way they are, there will no longer be difference between CGT 10% and CIT 30%. They will substantially be the same. That's the beautiful thing. That's the beautiful thing. But I want to state one more thing that we need to be sensitive to. Please, when you are computing deferred tax, we know we use a rate. Please, when a surplus constitutes a potential capital gain, the rate you use to multiply it to determine deferred tax is going to be 30% under the new law. Currently, you use 10%. Any potential capital gain arising that will arise on the potential disposal of a non-current asset, such capital gain is measured using the capital gain tax rate. So in the new regime, for all those of building equipment, right, they are evaluating that it translated into a capital gain surplus, portion surplus. That portion of the surplus that is related to capital gain will be multiplied by the CGT rate of 30% to arrive at your deferred tax liability. Let's take note. Let's take note. No longer, not 10%, 30%. I'm still going to say something in that regard as we go ahead. So this is the point. Tax expense appears as a line item in the financial of an entity whose profit is subject to tax. Therefore, for a small company or for a current medium-sized company that will be categorized as a small company based on its turnover, this line item will not appear anymore in the financial, just as it does not appear within the profit or loss section. That's what we are saying. Just as it does not appear within the profit or loss section, it will not appear again if you are a medium-sized company that eventually becomes a small company for the purposes of this reporting. Let's take note. So you will not see anything called tax expense anywhere for those medium-sized companies that subsequently become categorized as small company. Now, let me use the opportunity to answer Mr. Maeda. The question is asked. He said, what happens when there's a tax audit? Let's say you're a small company. Based on what you claim to be your turnover, you file, you do your filing, but the tax office chose to do an audit on you. And by the audit, they don't say, no, you are not a small company, sir. In fact, you ought to have paid us so many income taxes you did not pay and all of that. And they come up with a tax audit, with an assessment, right? Assessment, inspired by tax audit to say this is the amount you're going to pay as tax. But in your reporting, based on your judgment and your reportage, you'll be saying you're a small company or you're a medium-sized company that is not a small company. You did not present anything as a tax expense line item. So what happens where a tax audit triggers income tax liability? Now, this is it. In a tax audit, there are two sets of tax implications that flow from a tax audit. There are tax implications that arises on direct taxes. There are tax implications arising on indirect taxes. I take it again. When there's a tax audit, there are two sets of implications. Those one relating to direct taxes, those one relating to indirect taxes. The one related to direct taxes are the one when they say pay additional company income tax, pay additional education tax, pay additional, for example, IT, development levy, and the rest of them. So a tax audit, for those tax implications concerning direct taxes, when they arise and they are binding on you, and they are binding on you as an entity that has claimed that you're either a small company or there used to be a medium-sized company that is now a small company under the new regime. Where this arises, in that case, you have to recognize and present tax expense as a line item in your financial. In other words, in your profit or loss section, the first set of income statement you prepare following a tax audit that has triggered, that has led on assessment of an income tax liability. That income tax liability will be presented as the amount you will write along that line item called tax expense for that period. That is how it is done, right? However, the other component of tax audits, consumption tax not remitted, value tax not charged, this one not arising, all those other tax implications, please, they are not presented as a tax expense line item. I'm repeating it once again. They are not. They are not. You are going to present as part of your other expenses, but not within the line item called tax expense in your income statement. No, that is conceptually wrong. That is a material misstatement. You don't. And also, any liability arising by way of those new VAT payable, consumption tax payable, they are presented as other payables in your balance sheet or statement of financial position, not as current tax payable. No, never. Let's take note. Another thing we are fond of doing, when there are fines, right? There are fines for non-compliance under the tax law. There are many of them. There are fines, there are penalties. Please, tax fines and penalties are not component of tax expense. Let's take note. Tax fines and penalty, whatever they may be, 50,000 naira per day, 100,000 naira per day, 10 million naira for 5 million naira for country by country reporting failure of compliance. Any form of tax fine and penalty whatsoever, by any amount, they are not presented as part of the component of tax expense. The same thing, those fines and penalties not yet paid are not presented as part of the current tax payable. No, they are not. They are presented as part of the other expenses in your income statement, and they are presented as part of the other payable when they are yet to be liquidated by you. But please, not as a component, please, not as a component of your tax expense, not as a component of your current tax payable. Let's take note. So this is the tax information structure in a typical statement of comprehensive income. Now let's move on. Tax structure in cash flow. Yes, we all do cash flow. We have the direct method and indirect method. What is the implication for reporting under the new tax law? Not new tax law, the incoming, right? The incoming tax law, so to speak. Are there any implications of these under your statement of cash flow? So this is it. This is it. These are the two sets of implications. For a small company and for a current medium-sized company that has now become a small company, what I said before remains. In other words, look at this line item. Let me highlight it. There's a line item here called income tax paid. The one will present as the last item of deduction or adjustment under the operating activity section, right? If you are a small company under the new tax law, or you are a medium-sized company that will become a small company under the incoming tax law, right? Please, this line item will not appear. In case it's currently appearing, it is an error. If you are a small company currently, and there is no tax audit that triggered any income tax implication, for example, and there is no anything concerning income tax payable by you, please, income tax paid is no longer a component of the financial as a small company. I'm even talking currently now. It's not a matter of national tax bill, currently now. But what I'm highlighting this is for the purpose of medium-sized entities. Those group of medium-sized entities that will become small companies. For those ones, right, this line item will no longer feature in your financial income tax paid. Why? Because you are no longer subject to income tax, except the regular one, which is chargeable assets on which capital gainers are risen. Yes, unless CGT paid. Because CGT is not a function of exempted or not exempted. CGT is based on chargeable assets. You are exempted if the assets are exempted or if the instruments are exempted. You are not exempted if the assets or instruments or the underlying transaction are not exempted. That is the concept under CGT. It's not about the person. It's not because you're a church or you're a mosque or you're a big foundation. It's about the underlying asset or transaction. Is it CGT chargeable or is it not CGT chargeable? That is the question. But in summary, if you're a medium-sized entity that will become a small company, right? And you don't have any past obligation you are settling or paying, and there's no CGT liability paid within the period, income tax paid will not appear at all in any way. Now, my caveat again as before, when you're a first-time presenter of a financial under the new tax bill, and used to be a medium-sized company, it will mean that in the comparative year, there will still be something in the comparative year. Income tax paid under the current year is going to be a dash, nothing. But in the comparative year, there's going to be something there. Let's take note. But beyond your first year of transition, or rather, not transition, the IFRS transition team, beyond the first year of applying the potential tax law that's coming to being, after that first time, there will no longer be anything line item called income tax paid, either for the current year or for the comparative, not at all. However, if you're a medium-sized company under the current law that whose turnover is above 50 million, you remain a company chargeable to tax under CIT. So income tax will continue to feature in your financial as such company, and also for any other company that is currently a large company. That is the reporting implication we should take note of. So we move on.
OJ, please, before we move on, can I say something?
Yes, sir.
The current tax payable under a small company categorization in the potential new dispensation, is it possible we still maintain the note there and put dash dash and put a note under, put an explanation under the note that, yes, this company is currently a small company by our tax definition, and so we have a nil tax liability or a nil tax charge. Is it acceptable that way?
Okay, so let me clarify. Now, when you read a financial, under the IFRS framework, you are considered to be a standard reader of the financial, right? We are not teaching those in GSS3, bookkeeping and account. No, we are talking to a standard reader of a financial statement. Therefore, to answer you, and let me start from the current regime. If a small company now, you do not have an income tax liability thrown up based on tax audit, you do not have any carryover income tax liability that you did not settle, please, you have no business presenting any notes and putting dash, dash, dash. You have no business because you're exempted. Now, I'm going to make a note. We are going to get there. When we talk about the information about the reporting entity, when we talk about information about the reporting entity, that is where you have to state in your storytelling that your entity is exempted from profit tax in Nigeria based on the Nigerian tax law, right? When you write about the company incorporated on June 10, this and this, RC number is this, incorporation number is this, registered office is this, principal activity is this, you have to state somewhere around there that this entity is exempted from company and profit tax in Nigeria based on Nigerian tax law. With that statement, you have made your comment. So you don't write anything as a note and be putting dash, dash, dash. No, you have to state that within about the reporting entity. So that is what is to be done, sir, in that case. So when you do that as that statement, you don't need to go to note and be doing dash, dash, dash. No, nothing. You only go to a note where tax information is relevant for the comparative year when that entity was not yet a small company in that comparative year. So in the current year, it's going to be a dash, of course. But because in the previous year, which is the comparative year, there are going to be amounts of figure presented. Yes, we do that. But where a small company is a small company, in all intent and reality, for both the current year and the comparative year, we don't put dash. You don't put anything at all. However, in your information about reporting entity, you'll have stated that this company is exempted from company income tax, tertiary education tax, the development levy, rather, because we now have two classes, company income tax and development levy under the Nigerian Tax Act 2024. That settles it, sir. So that is the position, sir. Yes.
Yeah, thank you. And also, now, for a small company under the potential new dispensation, you will still continue to calculate capital allowance, but write them off.
Okay, thank you. Now, if you look at the guideline issued by the FIRS on the concept of it's not going to be exempted, from the day you purchase an item of qualified capital expenditure, you are considered to be consuming the capital allowance. Whether you've been taxed or not is another thing. From the date of purchase and put to use, capital allowance begins to run. Right? So if after certain years, you've exhausted the qualified capital expenditure on that item, and you now become taxable, maybe as a large company in the following year, you cannot go and fight to any capital allowance of the past. No, not at all. So under the tax law and the guideline issued by FIRS, when you are exempted from profit, it does not exempt you from the enjoyment of capital allowance associated with all your items of qualified capital expenditure. So that is the position, sir.
Thank you very much.
Yes, sir. Thank you, sir. So that was the position. Thank you. Okay, yes, I think I've answered that. Yeah, thank you. Now we move on. That is for cash flow, right? And I've explained what that is. VAT paid, consumption tax paid, any other tax that is not a direct tax is not presented here. But for a small company currently, and for those medium size that will be a small company based on 50 million naira turnover, they will not have anything income tax paid. Why? Because they become exempted from profit tax unless that gain, that tax arises on the disposal of chargeable assets or instruments on which capital gain tax arises. That is not about that on cash flow. So that was the indirect method, and this is the direct method. We are not bothered about whether it's direct or indirect. The same implication with what we have said. Now we move on. We want to go to the notes to the financial. What is the implication of the potential Nigerian Tax Act? What is the implication on the disclosure we do as notes in a typical set of financial statements? Generally, there are three categories of companies. There's a category of company that is permanently exempted from income tax. Permanently exempted from income tax. If you're an NGO, not-for-profit, charitable, ecclesiastical, all those companies defined under, is it section 24? Is it section 24 also of CETA? There's a group of companies, those entities that are permanently exempted. When you are permanently exempted, you take the DNA. You are like a small company, so to speak. You don't disclose any income tax notes on any entity that is permanently exempted from taxes, from income taxes, let's be specific. If you're a church, if you're a mosque, if you're an NGO, if you're a non-profit classified, if you're ecclesiastical, any kind of entity, right, cooperative society, identified under the law, right, you are exempted from income taxes in every form, except if that income tax arises on disposal of the chargeable assets, as I said, or a chargeable instrument. So, but if you don't have anything CGT in your kitty, you are not required to report or present anything about income tax as a note at all, because foundationally, you do not come under the purview of income taxation. I mean as an entity. I don't mean the payee you deduct, not the payee. I mean as an entity, right? Let's take note. However, if you're not in that category, right? If you're currently, if you're a medium-sized company, a large company, these are 4 minimum disclosure we must see in your financial. Four minimum. 4. Number 1, we must see a note that is the income tax expense, right? This note is indexed to the tax expense line item in your profit or loss and in your other comprehensive income. I take it again. You must see a note on income tax expense or income tax income where it is a credit. This note is indexed, is cross-referenced to that line item called tax expense within your profit or loss section and within your OCI. You may not have anything within your OCI, that is fine, but you must certainly going to have in your profit or loss section if you're an entity whose operation is not exempted from profit tax. So this is the number 1 note you must see as an index to the tax information in your primary financial statement. This is number 1. Number 2, we must see your reconciliation. We all hear about this, where a lot of folks do some JOMO and all of that. Now, you must see a reconciliation of the applicable tax rate to the average effective tax rate. This is the second note you must see for any entity whose operations or profit are subject to income tax in Nigeria. This second disclosure must be seen as a note to the financial. Number 3, consequentially, we must see current tax payable or receivable where there is such. Of course, where there is no current tax payable, which is rare, right? Where there is no current tax receivable, this will not apply, right? But ordinarily, because of the rarity of what I've just mentioned, you are going to see either a current tax payable or a current tax receivable or both. Under such condition, we must see a note speaking to the current tax payable or current tax receivable. This is indexed or cross-referenced to the line item in the statement of financial position under current tax payable or current tax receivable. It is indexed, so it gives a disaggregation, a breakdown, a componentization of the content of this line item. Number 4, you must see either a deferred tax asset or a deferred tax liability. As explained, in Nigeria, we do not do group tax filing. Therefore, if you are looking or preparing or presenting a consolidated financial statement, right? If you are doing that, in that consolidation, deferred tax asset net position is presented separately under the asset categorization, different from deferred tax liability position presented under the liability categorization. However, if the financial is not a consolidated financial statement, or if the financials are not that of a separate financial statements or individual financial statements, deferred tax asset or liability is presented only as a net balance, as a single line item, either as a deferred tax asset or as a deferred tax liability, as the case may be. Just a second, someone is asking, if NGO earns rent or interest from fixed deposit, if the NGO is still exempted from common income tax. Now, under the current law, right, under the new withholding tax regulation, you suffer withholding tax on interest and fixed deposit, and that is final. And that is final. Yes, you suffer with, and that is final. You don't come and begin to claim, that is final. And that is the current position. But before, it can be something different. It can be something different, but that is the current position. So as I'm saying, in a separate financial statements or in an individual set of financial statements, it is either a deferred tax asset or a deferred tax liability. So these are the 4 notes we must see. Therefore, what is the implication or what are the implications of the potential tax bill that will be signed into law on this notes disclosure in the financial? Here we go. Number 1, income tax expense. Let's look at the component first. So, colleagues, look at what you have on your screen. You see, this note, I said this note is indexed to the tax expense line item in the financial. You recall, it is indexed. Now, this is a disaggregation of the component of that line item. When we say income tax expense, these are the composition. We have the current income tax. We have the tertiary education tax. We have the information technology development levy. We have withholding tax on dividend receivables like received, as the case may be. We have capital gains tax, right? Then we have prior year under or over provision. That is the one arising from a tax audit, practically. These are the typical components of a current tax, or of an income tax. These are the various composition, all of these. Now, how will it look like now if these laws, if these bills are signed into law? This is the meaning. Everyone, please look at my screen. Look at what I'm doing now. Please stay with me. Look at this item I'm highlighting. These three items will no longer be part of your component of disclosure. Let me put them in red so that we know what I'm talking about. These three items will no longer be part. You're only going to have, and please, I'm referring only to large company that are calling large company, one, then two, those medium-sized company that will remain as large company in the new dispensation. Those are the ones I'm referring to. Of course, I've said before, for the umpteenth time, that a current small company or a current medium-sized company that will become a small company will not even have to present anything concerning tax. I said it clearly. So I'm doing this on the premise that we are dealing with a large company or an entity that is medium-sized that will be reclassified as a large company in the new dispensation. Therefore, in the note to the financial, these three components will no longer exist. What we're going to have, we're going to have company income tax. You write the amount, followed by what? Development levy. So the tertiary education tax, the information technology development levy, right? Then the NASENI, is not here. NASENI, what's the name? Nigeria Police Trust Fund, all of those things, right? They will cease to exist. They will cease to exist. So all of them are contained in what we call development levy. I repeat, NASENI is not here because it's not a bank. Which other one? Even here, cybersecurity levy is not here. Nigerian Police Trust Fund levy is not here. So three items are not here. But please, those three items, right, plus these ones will not appear as part of your component in your notes to income tax expense. You are going to have company income tax, state the amount. You are going to have development levy, state the amount. You are going to have capital gain tax, state the amount. And of course, the effect of under or over provision flowing from a tax audit. So these are the four components going forward. Please, for all companies in Nigeria, for all large company in Nigeria, which will be made up of the current large company and those medium-sized companies whose turnover are above 50 million, that will be classified as large company. Yes, that is it. Four components: company income tax, development levy, capital gain tax applicable, and then effect of tax audit, which we'll call prior year under provision / over provision, where applicable. These are the four components for all companies. Not all of this again. That will be the nature of the structure going forward. I'm going to come to you, Mr. Fobike. I'll be with you shortly, sir. Now, I want to clarify something. In your first year of complying with this new law, recall, we do comparative reporting. If you're reporting in the first year, where we will be complying with the new tax law, in the current year, as I said, these other items I highlighted in red will not be there. The new one I mentioned, the CIT, development levy, CGT were applicable, and effect of tax audit revision were applicable. They'll be there. But please, in your first year of transition, no, why do I keep saying transition? In your first year of implementation of the new tax law, these things I've highlighted in red, they will still be there, but they will be with respect to the comparative year. In the current year, it will be dash, 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 but they'll be there for the comparative year. Whereas the development levy will appear for the current year, it will be a dash for the comparative year. But in subsequent reporting, nothing of such will appear anymore. You only have your company income tax, your development levy, your capital gains tax where applicable, and then any effect of over or under provision arising from a tax audit. Yes, Mr. Fabrike, yes, your comment, please.
Okay, thank you, sir.
Thank you.
Can you hear me, sir? Okay.
We are with you. Go ahead.
Yes, I understand that going forward, all those red items will not be there. But you made mention of this police trust fund. You know, if you are filing a report on federal revenue, which is going to be changed now to revenue service, you find out that they program their system. The system will automatically charge you police trust fund. So, but I can't see it here. You say it will not be longer. It will not be there again. Yeah, I want a clarification on that.
Thank you, sir. You know, I said before when I started this class that you know, I've advised people to slow down on the need to talk about or write about tax implication. Tax practice implication, right? Because there are transition consequences. They what we call transition implementation. You know, there's a gap analysis. When this bill is signed into law, there's going to be an overhaul of the tax formats. Are you following me, sir? There's going to be an overhaul. And that overhaul is the rewriting of the algorithm, is the restructuring of the outlay, is the restructuring of the template to recognize only 3 classes of taxes for a company. That is your CIT, your development levy, and then your CGT. Simple. So when we have the other tax formats, also now in restructuring, now we'll talk about IT transition effect. In the tax technology that we have in Nigeria, it's going to be recoded to recognize only 3 tax line items, right? The CIT, which will be 30% based on your total or taxable profit. We give you the figure in that box. Then the development levy, which is 4% on your assessable profit. You see, there are different tax bases. CIT is on your total profit. 4% development levy, that hopefully that will come, is going to be on your assessable profit. So those are the line items. All those are Nigerian Police Trust Fund, NASENI, Cybersecurity Levy, Information Technology Levy will no longer be there. Those fields will be gone and gone. So there's going to be a technology adaptation, right, to align with the provisions of the unit tax law. So that's a technology implication that has to be dealt with by the FRS or NRS at that point in time. That's why I said there's going to be a transition period from the side of the administrator, regulator, from the side of practitioners and consultants and companies. Yes, so that is it. So we are not going to run the new tax law on the template, right? On the template of the current tax law. No, not at all, not at all. No way. Sir, did I answer you, Mr. Fabike?
Yes, you answered me very well, sir. Thank you. But there's something that is confusing me. The line item of prior year under / over provision. This is in the aspect of a company. Then in the aspect of tax authority, you know, we that are into practice, you find out whenever they carry a tax audit on a company, they maybe they say they are covering 6 years back duty.
Correct.
Then you find out whenever they arrive at any assessment, the same their system, which sometimes I used to argue with them. I told them that the tax promise is not a tax law, but it's a mechanism in place to help them to facilitate their tax collection. You understand? You find that their tax system, when they will, inject the tax liability on the company they have audited, they will tell you the company, the company system will start charging penalty and interest on those prior year. So assuming now a company made a provision, maybe for 2024 accounting year now that they are filing, you made a provision of 1 million as a tax liability. Then after this year, FIRS will not come. That maybe after like 3 years, they will come and say they are auditing you. I want you to help us on this matter to clarify. Is it right for them to apply penalty retrospectively on those years where they're supposed to come, but they did not come.
Okay, I get you.
As Wendy.
Okay, I get you. So this is it. And let's also look at it from, holistically. Now, at the end of the year, when you do your computation, you are expected to apply the thinking of the tax authority and the tax law in coming up with an estimation of what your income tax liability will be. However, it is discovered as most time, entities and their consultants, they, in their own judgment, under-assess and under-provide for what should be the tax liability. After your adjustment, you say, okay, everything, add back, deduct. Let's assume this. You come up with 2 million naira, for example, right? As a provision for income tax or current tax payable, 2 million naira. You did that in year 1, you pay in the following year before June. You did that in year 2, you paid in the following year. Then maybe in the 4th year, they now landed for tax audit. In that tax audit, they're now looking at the whole years. In looking at all those years, to be honest, it is a duty to do an assessment to ascertain that you ought to have considered what they're considering in arriving at a given tax liability. However, if what you provided for was 1 million as against 1.5, it is not a duty to have helped you to arrive at 1.5 instead of 1 million if you had done a neutral, balanced consideration from the side of your payer and from the side of the government. So if they do the analysis in year 1, their audits, they say, why did you not disallow this? You didn't disallow this. What do you know of this one? CSC filing expenses. If they disallow all of these things, they now give a reverse assessment of 500,000 in year 1, 300,000 in year 2, 100,000 in year 3. They now come up with that. Now the thinking is that you ought to have used their own kind of thinking, judgment, based on the law and the base operation, that you ought to have come up with that kind of amount or something substantially close. However, we know the difficulty when someone comes to do a tax audit, the person is bent on discovering what should not be discovered. In fact, the person is committed to, arriving at a pre-conclusion, even before looking at a record to do any form of review or audit. We know it happens. But if you look at it, it is neither here nor there. Where they come up with additional assessment that gives you something higher than what you have provided and paid for, yes, they consider you to have been defaulting for not having paid that commensurate amount in those past years when you're doing your own self-assessment and payment. So if you look at it, it's a difficult one. It's a difficult one of saying that how am I supposed to know how they have risen concerning some line items? Or is it that the case of they are being too petty into the analysis of an expense that should be allowable or of an expense that should not be allowable and all of that? So it's a difficult one. It's a difficult one. But if in all honesty, the assessment is not biased, is neutral, and their consideration of income and expense reviews that, sir, that you are underprovided by 100,000 naira every year for 5 years, that means you are in default of not paying what you ought to pay for those years, and then the fine and penalty should go. So it's neither here nor there, but that's just the unfortunate reality. But flowing from what you said, the tax code max is going to be reconfigured, to enable filing under it. We can't go on what we have now. It does not work that way. There's always a rejig to suit the new technology and tax base and line item in the potential tax law. But I chose not to speak on that one because I'm not the regulator, right? And that's not within my power, right? So, but certainly there's going to be a tax technology, restructuring to suit the provision of the new tax law. Yes, so that is that about that. Mr. Fobike, can we move on?
Yeah, thank you very much.
Thank you,
we
sir.
can move on.
So this is the first component of the notes that the normal levy will come in: education tax, information technology levy, NASENI, cyber security levy, Nigerian police, that they will no longer be, you no longer find them. Let's take notes. And I'll explain what happens for the first year you're applying the potentially new tax law, and as to comparative and current year information, and what will happen subsequently. I've explained that, right? Now, please, that development levy is shared among the relevant agency, Nigerian police, that's the security, the defense fund, the education, which is the NEL fund, right? National Educational Loan Board, then the NASENI, and then the NITSDA. So that 4% bulk money is shared among them certain percentages. But that's not our work for this purpose. Our emphasis is the line item that will no longer appear as a subcomponent of note of income tax expense, and the new one, development levy, that appear in its place as a single one-line item. So we are done on this component of income tax. Let's take note of the practicality.
Please, I have a question, please. I have a question, please.
Okay, sir.
Can I ask?
Go ahead, sir.
Yes. You didn't mention deferred tax as part of the components. Where will that one come in?
Thank you. Now, if you look at, let me highlight, there's deferred tax here. There's deferred tax here. Look at origination/reversal of deferred tax. So if a large company or a medium-sized company, right, that will remain as such in the new regime as a large company, look at it, the one I've highlighted now. Let me use color blue, for example. A second, please. Yes. Yes. So that is the line item. So it is the summation of your current tax totality, right? And the deferred tax that gives the income tax expense. So this is unchanged. This is unchanged, like I said. It's unchanged for a large company now, and it's going to be unchanged for a medium-sized company that will qualify as a large company in the incoming tax regime. So that is that about that. So it's there, sir. I only emphasize on this one that is entirely radically different from what we used to have.
Thank you.
Thank you, sir.
Thank you.
We go to the number 2 disclosure.
Hello, sir.
Yes, sir.
Hello, sir.
Yes, sir.
What is the position of the?
Good day, sir.
What is the position of test fund?
Okay, sir. Inside that 4% development levy, a percentage will be given to test fund.
You say what?
If I mentioned a development levy of 4% that is coming to replace all those other ones. It is that 4% that will be shared between test fund, between NASENI, between NEL fund, National Educational Loan Board, between Information Technology Development Levy. It is that 4% that will be shared among all of them, sir. All of them. It will be shared. But not by the company. Your own is to charge a development levy and pay into a designated account, right, of FIRS. So it is a duty to remit, right, to the, to the federal government account that does the allocation, as the case may be. Yes, sir.
All right.
Thank you, sir. Thank you, sir. Thank you, my chief. So now, if you look at this, let's come to reconciliation. Now, a quick explanation. This is it. If I'm reading your financial, I did not see how you computed the income tax. I did not see your tax record. I don't know the adjustment that you did. But you are telling me, sir, that you're in your country, right, that the income tax rate for a large company is 30%. That's what you're telling me. And you're telling me, sir, that in your country, the income tax rate for a medium-sized company is 20%. Why is it that if I take that 30% you've told me, or the 20% you've told me, and I multiply it with your PBT, profit before tax, why is it not giving me the amount? Why is it not giving me the amount that I'm seeing in the financial? I take the 30% you've told me, 20%, and I multiply the PBT. You should give me the tax expense. Why is it not giving me? That is the essence of this reconciliation. 30% or 20%, I mean in the current regime, times your profit before tax should give you your tax expense. But we know it is not so. Do you know why? Because in our income tax computation, we add back non-allowable expense, we deduct non-taxable income, we consider capital allowance, we consider carried forward loss relief, and all of that. So we do a lot of adjustments in arriving at that profit that is now taxed. But a reader of the financial or an outsider, right, does not see it. That's what we're saying. Does not see it. A rate of financial does not see. Therefore, there should be a way to explain what ought to have been the tax expense based on the tax rate became something else. That is the meaning of reconciliation of the applicable tax rate to the average effective tax rate. That is the meaning. Now, what is the implication for us under the new tax regime? So, colleagues, let me highlight them. From here, yes, these two items in red will no longer form part of the reconciliation. Why? Because we will no longer have tertiary education tax. Sorry. No, capital gain is part of it. I mean, I'm sorry. So let me correct this back to the black that it was. Now, we are not going to have education tax anymore as part of the line item here. We are not going to have NASENI. We are not going to have Information Technology Development Levy. We are not going to have Nigerian Police Trust Fund. We are not going to have Cyber Security Levy. Now, these that I mentioned that are not here, they are common to big companies, banks, IT, pension, insurance, companies with turnover over 100 million and above. Those are the category. That's why you don't see it enough financial. But please, in our reconciliation, we will no longer see tertiary education tax. We will no longer see NASENI. We will no longer see Information Technology Development Levy. We will no longer see what's the name, Cyber Security Levy. We will not see all of those things in reconciliation. We only see one new item, which is development levy, and it is 4% of the assessable profit. Yes, my e-bishop, Ofure, go ahead, sir. You have the floor.
Yeah, good morning, sir. I appreciate you for this important lecture. Now, my question quickly before I forget is, there are some complaints that we may be consulting for, those of us that are in the consulting space. They've not done audited financial statement. They have backlog for 4 years, 5 years, and they will just invite you as an auditor, come and audit us from inception, 5 years, 4 years. So how do we, in doing those backlog, are we going to maintain the existing format of presentation, or is this new law, are we going, by the time we get there, are we going to now apply retrospectively, or we are going to have 2 regimes of reporting? Thank you.
Thank you, sir. My bishop, you said it. You said it all. We are going to have 2 regimes of reporting. You prepare a financial based with record to tax information based on the tax law that applied within that period covered by that financial. So anything from 2024 backwards, apply the tax law that applied within that period. If it's covered 2018 backward, remember in 2018, in fact in 2019, right, Finance Act did not apply. Finance Act began to apply from February 1, 2020, if you remember. So depending on the regime, you have to apply what is applicable for that regime. If the tax bills are signed into law and are effective from 2026, it means what we're discussing here will be used to deal with the reporting of 2026 financial, and beyond. So it's according to the framework that is applicable within that time frame where your considerations are being made, sir. So that is about that. So in the reconciliation, let's take note. Development levy is going to come into the picture, and these other ones will not be there, right? But capital gain tax will be there. These other components of reconciliation will remain. But the 5 things, is it 5 or 4? Tertiary, NASENI, ITF, cyber security. Yes, there are 5. Nigerian Police Trust Fund. They will no longer be part of the composition of reconciliation. Only one item will be there, which is development levy. Also, remember, as always, the comparative effect, we are doing it for the first time, right? That is number 2 disclosure, and what happens in the potential regime won't be reporting. We go on. Now, let's go to the component of current tax payable. Yes, in current tax payable, it is simply a disaggregation of the opening balance, the tax paid, the tax that arose within the year. For a large company, 1, and for those medium-sized company that will become large company under the new future regime, these disclosures remain the same. for a current large company and for those medium-sized entities that will transit into becoming large company under the new official regime, these disclosures remain the same. However, I'm not talking about small company because they're currently exempted even now. For those medium-sized entities, for those medium-sized entities that will become small companies, right? If they are not carrying forward tax obligation, or there is no capital gain tax liability arising in that period, there will not be anything on this in the current year. There may be in the comparative year where you are presenting your financial for the first time, meaning it is dealing with the current year when the new tax law will start, and the comparative will be from the past year when the former regime existed. But in your subsequent reporting, from those medium-sized companies that will now become small, there will not be disclosure in this regard at all if they do not have any backlog or there's no tax audit triggering any assessment arising from such tax audit. That is the implication in that regard. We go to the last one, the deferred tax note. Yes, you know for every deferred tax in your financial, there is a note. And that index on the note is going to give, you see, if you go to paragraph 82, no, sorry, paragraph 83G, yes, of IS 12, where you have subsection G there. When you give us a note on deferred tax, there are some things we want to see. Don't tell us deferred tax balance in balance sheet 20 million. You go to the note, 20 million. You've not said anything. You didn't say anything, nothing. That is not a disclosure. When you say deferred tax 20 million and you index it with a number, maybe note number 23. In the note number 23, there are a number of 4 things we must see about your deferred tax balance. Number 1, we must see the items upon which deferred tax arose. We must see the items: PPE, investment property, intangible assets, inventory, right? Trade receivable, and we must see the items. Number 1, we must see the item. Number 2, we must see the opening balances of deferred tax and those items. That's number 2. Number 3, we must see the movement in that year or the change of deferred tax on that item. That's number 3. Number 4, we must see the closing balance. This is the minimum 4 things we must see when your note is speaking to the line item in your balance sheet. The deferred tax component, the opening balance for each of those components, the movement in each of those components, the closing balance in each of those components, 4 things. Then the 5th one, the disaggregation. Why disaggregation? When you present deferred tax under IFRS, when you go to IS1, right, paragraph 54, it tells you that deferred tax will be presented as a non-current item. That's what it states in IS1. At all time, deferred tax is presented as a non-current item when you are doing a current, non-current approach. You know, non-current and current approach. That deferred tax will be presented as a non-current item. Even if you are doing an order of liquidity method of the balance sheet, deferred tax is still presented, but just in its order of liquidity. IS1 stipulates you must disaggregate a deferred tax balance in your notes into the portion that will be recovered or settled within 12 months and the portion that will be recovered or settled after 12 months. You must disaggregate into these 2 groups. That is the reason for what I'm having here. Let me highlight it in blue. That's the reason for what we're having here in blue. So the balance you have as at the end of the current year, you must break it down. The portion that will be settled within 12 months and the portion that will be settled after 12 months. Now, what is our business with this concerning the new tax that will come? How is it our business? This is our business. Number 1, I've said, for the large company and medium-sized company that will become large, everything remains the same. But for those small medium-sized company that will become small company, right, deferred tax will no longer be recognized nor presented in their financial. Therefore, there is no deferred tax in the financial in the first place, so there will not be need for a note. Apart from in the first year when there's a transition and all of that. Let's take note. Where comparatively you state what you should state. But if you're a small company currently, of course, you are not even part of our discussion, and you are a medium-sized company that will become a small company, deferred tax information is not required for that current year. In other subsequent year, nothing on deferred tax will appear, whether for the current or for the previous period. Let's take note. Now, for details on deferred tax and all of this, I have the book I've on deferred tax that deals with that all of these are dealt with, right? So, but that was by the side. So this is the fourth implication on the note disclosure. Now, as we move ahead, we are done with those notes. Now, that was called background information. We have in financial. Background information, when you write about the company, let me give us a sample. Let me read. Look at JKL Limited. JKL Limited, I'm talking about the reporting entity now, the implication that will flow from this new tax bill when signed into law. JKL Limited, hereinafter referred to as the company, was incorporated under this. The head office is there, blah, 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 blah. Now, look at something I want to emphasize. When Finance Act came, this was the wording when you are describing a small company. The company is classified. I'm reading what I have in blue. The company is classified. Let me zoom out more. The company is classified as a small company under Nigerian Finance Act. As a small company, the company is exempted from paying any form of profit tax on its profits. It is also exempted from paying minimum tax where loss is made. This is the wording about the reporting entity in any IRS financial for a small company. So you don't need to go and be writing income tax, tax expense, dash. No, that dash is not necessary. You are to have reflected the tax ideology, the tax DNA of that entity in your information about that company. And this paragraph tells that information. So if I read this information, I don't expect to see tax expense, dash. Deferred tax, dash. Current tax payable, dash. No, that is not necessary at all in any sense, unless there is an information about that in the comparative year. This information is critical. Now, let's go back to the tax implication. If you are currently a medium-sized entity or a consultant to a medium-sized entity that pays 20% income tax, if that entity becomes a small company under the incoming regime, this wording will come in. But it will no longer be a small company under Finance Act. It is classified as a small company under Nigeria Tax Act 2025, as the case may be. So let's take note about this information about reporting entity. Very important. Yes, the material will be shared. We are going to upload it on our YouTube page and share the link. Then you can go there to, to watch it as much as you want. Now, we move on to the next, please. This information is about reporting entity. It is important that you put the tax status of your entity inside your about the information. If you are a small company, if you are a large company, it is presumed, no question. You pay tax, you do all the necessary. So we'll move on. Next, now, this is one I've spoken to. If you are currently a medium-sized company, your terminology is going to change, right? You word it in the way I've worded this small company. The way this has been worded, if you are a medium-sized company, as we have here, right? This is what we have here currently in Nigeria. But in the new tax regime, your information will be worded to be in this way. Let's take note. Now we move on. This is the wording. For large company, the information about the large company remain the same. There is no issue about that. Now I come to this part on income tax policy. Please, when we write our accounting policies, you know what we used to call statement of significant accounting policy. We no longer call them significant accounting policy. We call them statement of material accounting policy. That's what we call them. For 2023 accounting year end, we can now call them statement of material accounting policy. Because IAS 1 and IAS 8 were amended in 2013. Because there's no definition of significance, the word material is now used. We call it statement of material accounting policy. This is where I'm going to. One of those accounting policy is on income taxes. Please, You need to go and reward wording. That's what I mean, the wording. Go and reward your income tax policy to reflect the new position when the bills will be signed into law. And what is the new position? The position is dependent on whether you are a medium size that becomes a small company, or you are a medium size that has become a large company. Do you see it? Medium-sized company will be bifurcated into two. Those that will become small company and those that will become large company. Whether you become a small company or whether you become a large company, there's an implication in your income tax accounting policy. So please, you need to go and amend it. Now let me read here, and we're going to see the amendment implication. I'm reading on default on current tax. Look at the accounting policy, the income tax accounting policy. It says, current tax is that income tax payable or recoverable on or from taxable profit for the reporting period. It is made up of company income tax, tertiary education tax, and capital gain tax. So in our amendment, it's going to be, it is made up of company income tax, development levy, and capital gains tax. Simple. That is the impact for that medium size that has become, right, a large company. For that medium size that become a small company, this tax information will not even appear in your financial. Why? Because we are exempted from tax. Based on that information I just read some minutes ago about the reporting entity that is a small company. So as a medium size, you either become small company or large company. When you're a small company, you don't need to disclose your income tax accounting policy because you are no longer taxed, except if there is a CGT information. So when you are now a large company, you need to now reward your commentary that your current tax comprises company income tax, development levy, and capital gains tax. So I read on. Let me read on from here. It says, for company income tax, it is measured at the statutory tax rate of 20% on total profits of the company. But for a medium size that become a large, it's no longer 20%, it becomes what? 30%. That needs to be adjusted. For tertiary education tax, it is computed at 2% of taxable profit. And for capital gains tax, it is measured at 10%. Now, all this will change. For company income tax, for that medium size that become large, it is what? 30% now. CGT, as proposed, if signed into law, will become 30% as well. Then there's a development levy measured at 4% of assessable profit. So no more tertiary education tax, NASENI, cyber, Nigerian Police Trust Fund, information technology, IT development levy, they will no longer be part of the measurement of current tax. That is the implication. So with this, we've come to the end of this series, and I want to thank you all for joining me so far.
Thank you very much, OJ. Sorry.
I'm coming, sir. Before we take a question, a second, sir, we're going to take question and contribution. I don't want to introduce to us, by the grace of God, the new book I've written on Guide to IFRS Compliance. Guide to IFRS. Oh my God. Guide to ICFR Compliance. ICFR. All my head is IFRS, so everything is IFRS. Guide to ICFR Compliance. So for all entities preparing their financial this year, for 2024 and going forward, right? You are required to submit some disclosures in your annual report concerning ICFR, right? So we've taken pain and detail to go into from the history, the foundation, what is to be done. When you get this book at chapter 3, you see the very laborious consideration. You don't just say an internal control system is effective. What are your pieces of evidence? What are documentary basis for you to assert that internal control is effective, or that management assessment of internal control, right, gives assurance as required? So for every line item in a financial, every line item from the balance sheet to the statement of comprehensive income, every line item, what question should be asked? What evaluation should be made to come to the conclusion that there is no material misstatement? This material misstatement may be an omission. This material misstatement may be, maybe a commission. It may be a disclosure non-compliance. All of those things you find in the chapter 3 of this book, where we picked line item and asked a set of questions that you form the basis of your documentary evidence of having assessed an internal control in come to a conclusion whether it is. So this book is great, it's very practical, and it contains 3 appendices: guideline by the FRC on management report on internal control over financial reporting. It contains the guideline by SEC on ICFR for public company. It contains the guide by FRC also on what an engagement assurance practitioner should report when they review assessment that has been done by the management of an entity. So all of those things are here. All of those things are here. But the chapter 3 is very critical because it asks those questions that you should ask before you come to a conclusion or judgment. The internal control system over financial reporting is effective, or that the financials do not contain material restatement. It's not just done by word of mouth. Questions are administered, information, evidence are gotten, and a decision is reached. How is it done? We see it here. So it goes for 20,000 naira, and we can get across to you anywhere you are in Nigeria. It goes for 20,000 naira, inclusive of the courier cost to any part of the country that you are. It's about 260-page book. Of course, you can see A4 size dealing with all of this. So we are the sole, of course, I'm the author, as you know, thankfully to the glory of God. And then we are the sole marketer. My team are the sole marketer. So you are not to get it from any other vendor anywhere within or outside of this country. So this is it. So if you are interested, if you're on our platform, you reach out to my training coordinator as usual, or you reach out to me, we get it across to you. 20,000 naira, including courier, fantastic book, detailed book, a great guide to the judgment you are going to make in the process of ICFR compliance. Thank you for listening to me. So we now go to question and comments on it. The book is 20,000 naira. Yes, Mr. Lauren Femi, just send us an email. Mr. Nyema, we're going to, get them across in Kano, anywhere you are in Nigeria. So the floor is open. Question, commentary on what we said so far.
Thank you very much, OJ, and wishing you many happy returns in Jesus' name.
Amen. Thank
you. Yes, my question is on the last item you treated in the lecture, this 1.1 foreign tax.
Okay.
You mentioned current tax to be a composition of company income tax, now development levy under the potential new dispensation and capital gains tax. Well, you did not mention anything about over or under provision of prior year tax, which is an element of the current tax. Because sometimes it can even be, it can be substantial, it can be material.
True.
And in practice, many companies, some people will say, okay, they would rather treat it under retained earnings and not current tax. And so we need to mention something about it.
Okay, sir. If you look at it, when we presented that over provision, under provision as a note, we did that. Because we are disaggregating. However, sir, your under provision arises on the type of tax. It is either it is on company income tax or development levy. It is not the type of tax in itself, sir.
So,
I don't know where you're getting me. So it is not the type of tax. It's a component. It is either under or over arising on company income tax or development levy, or the CGT you declared, which they say, okay, you're under declared. That's not what you made and all of that. So it is not a distinct type of tax. It is either a CIT or CGT or development levy. So that is it. At tax law. So when you state this, it encompasses, all of that as a policy statement. But in the disclosure, we disaggregate because we have to break down anything material into their subcomponent. That is how we did that. So this suffices, sir. Yes, sir.
Yes. Thank you very much. But like I mentioned, some companies they will say, okay, they would rather charge it into retained earnings.
No, it's
And
wrong,
choose
it's
it
wrong,
to
it's wrong, sir.
capital.
So it's wrong. Please,
So,
any change, any other
the
provision,
problem.
sir, any other provision or other provision is a change in accounting estimate.
Yeah.
It is presented as you know, currently and prospectively into the future. It does not go to return any, not at all in any form, not at all. That is a non-compliance. Yes, sir. Yes, sir. Yeah, my bishop, go ahead, sir.
Yeah, once again, good morning, sir. Happy birthday, many happy returns. Thank you for this wonderful lecture. May God bless you.
Amen,
now, I have a comment on the income tax policy.
Okay.
Because we believe that significant or material policy statement should drive the accounting life cycle. And the business is a going concern that if in a particular year, the company is still struggling, they've not reached 50% revenue, the next year, they can, if God bless them, they can reach it. And the accounting policy should not be something that will be changed maybe all the time. So I am thinking that the accounting policy could probably be worded in a way that it will show that the revenue strength of the company dictates the account in line with the extant law. So that way, irrespective of where the company, because you can look at an hypothetical situation whereby a company was prosperous in 2025, maybe in 2026, due to government policy or one thing or the other, they slided back. So those are rare cases where a company has been classified by status based on revenue to be a big company, and the company experienced a decline, is now falling back to, so how do we address that? Then secondly,
hello, Bishop, are you there? I think we lost him.
Which is now a question, is revenue for certain businesses. For example, for consultancy, is your consultancy fee, your professional fee. That one is straightforward. But there are some clients, for example, one of our clients who is into agency, advertising agency, and whatever.
We are losing your audio. I hope if you can hear us, we are losing your audio.
He's going to carry out just maybe a percentage. Hello?
Yeah, we lost at some point, but go ahead. Yeah.
I said for that kind of a.
Wow. But I think I get you, Bishop Ofre. I get you.
That when client pays and so how do you get the price of that? How do you arrive at the revenue so that it's not charged? Because let's say he receive 4 million as income. Out of that 4 million, is going to pay 3.5 million to the agency that will carry out the advert, the company that will, the advertising agents. Maybe 500,000 naira is his own margin. So how will he arrive at? Because at the end of the day, his turnover is not his actual turnover because of the margin that he's going to spend. So how do we arrive at his real turnover so that it's not classified wrong?
Yeah. You know, the way it is done. Thank you so much. Now, let me start with the first one. I am a small company this year. I'm a small company the following year. The third year, I become a large company. How should we word or disclose material accounting policy? Now, this is it. Accounting policies are disclosed where they are related or where they define any line item contained in the reporting period financial statements. I repeat, accounting policies are disclosed in a set of financial statements where they define or speak to any of the line item contained in the financial statement. A line item may not exist in the current year, but they may exist in the comparative year. That they do not exist in the current year does not mean that the associated material accounting policy should not be included in the report. It should be included in the report because that line item may exist in the comparative year. So for any line item that exists, whether in the current year or in the prior year, the associated accounting policy that defines the origination, processing, and reporting of that line item should be included in the financial statement. when an item does not exist in a financial, whether for the current year or the comparative year, it is not required, it is unnecessary, it is superfluous to disclose an accounting policy for a line item that is neither present nor reported in the current year nor in the previous year. About accounting policy development, accounting policies are developed to cover every likely DNA of the transaction of an entity. You can have 1,001 accounting policy, but the one you select from your dossier, from your book of accounting policy, the one you select to include in the annual report are those ones that pertain to transactions or items that occur either in the current year or in the comparative year. So that is what makes it, and that is why if you look at the structure in IS1, they tell you statement of material accounting policy. Even for some minute item there in the income statement also, you may not need to include the accounting policy when the item is considered not material. And the American will say, they have a definition for materiality. They say, materiality means any information that will make an investor decide otherwise if that information was there before the initial decision was taken. Any information that make a reader decide otherwise if that information was there at the first time the initial decision was taken. That is when the information is said to be material. I love that description of materiality, right? So that is not about what to include, when to include, or when not to include accounting policy. Now, on agency relationship transaction, yes, there must be a contract between the principal and an agent. That contract stipulates the terms and conditions covering that agency, right? And therefore, as we said, the inflows into the account of the agency do not represent revenue. Revenue in the word of IFRS 15. They do not constitute revenue. So in the revenue policy of that entity, the entity has to be categorical and clear as to what is, about the entity. You will have told us that you're an agency, you are a PR agency, you are a marketing agency, you are a sport betting agency, you are this agency, you are that agency, or you run a franchise. You will have told us about your entity and what you do. That is the importance of that information. Then in your accounting policy of revenue, you are to define what your revenue is, the structure of your revenue transaction, and the kind of income or revenue that you make as an entity. So you earn 3% of the sponsorship fee of this, or you earn 60% of the sales made on behalf of your principal, you earn 90% of the commission made, you make 3% of the brokerage fee of the portfolio being managed by you. Whatever those terms are, you are to reflect them in the accounting policy. But most accounting policy are just copy and paste. When you read them, you cannot even reach a conclusion as to the meaning of that policy. It's just copy and paste, copy and paste, copy and paste. It does not speak to the DNA. It does not speak to the DNA of the entity itself that is there. So Bishop is about that policy. The policy must reflect the contract between the agency and the principal. And that is why under IFRS 15, number one condition that there must be a contract. That's number one condition, that there must be a contract. That's number one in the 5-state consideration. So that will guide the, the documenting of the revenue policy, and also that will help the revenue authority to believe you, as the case may be. So that is that about that. Bishop, are we fine?
Yes, sir. Fine, fantastic. We are fine. Thank you very much.
Thank you, sir. Yes, Oga Cyril, you had a comment to make. You go ahead, please. And other people, comment question before we sign out. Okay, let me read the chat here. Oh, thank you, sir. Okay, yeah, Mr. Martin Adeleke, send us your phone number. We have a platform for professionals where we discuss and analyze on technical issues. We don't do happy birthday there. We don't do happy new month. We don't do any other thing, just analysis. So send your phone number on this chat. We are going to add you. My team will add you on that platform. Thank you, Mr. Bodo. Oh, thank you. Oh, wow, great. Thank you, Victoria. Thank you very much. Now the link is there for all our books. We are going to upload this one within the next few hours. If you click the link there, you're going to see all of our books that we have there. Mr. Ifeanyi, Ezigbo, thank you so very much. Now, any other comment? Yeah, Mr. Cyril Oriafo, go ahead.
Yes, OJ, I have a comment.
Okay, Mr.
Hello,
Samuel.
sir. Hello, sir. Mr. K. Okay, hold on. Hold on. Let's get serious. Let's get serious, sir.
Okay,
I'll come back
Mr.
to you.
Samuel, I lost the audio at some point. Thank you for this opportunity. What I want the comment I wanted to add, I know you addressed it while addressing his own concern. What the only thing I will just add is that there's this impression that even most concerns also have. They just pick up your bank statement and they assume all the inflow to be autonomous on your revenue. It doesn't add up. This is your responsibility to tell the taxman what constitutes your revenue. That's just what I want to add in that regard. Every other thing you have said it already. Thank you.
Oh, thank you, Mr. Oriafo. Yes, okay, you have the floor.
Thank you very much, OJ. My question is, when we are getting your birthday cake?
Okay, don't worry, we're going to share you birthday cake, sir. We're going to share you birthday cake, sir.
Thank you very much.
Thank you so much. Any other comments? Okay, question. Okay, thank you. Thank you all. Thank you so much. Thank you for the birthday wishes. I think basically we are done. Thank you for your time. It's been wonderful with you. I'm grateful. I'm delighted. I'm honored to have all of you. Support me over my professional journey. All right. We write, you buy, you criticize, you support. We run training, you attend. We thank you so much. Without you, we couldn't have been this better. Thank you so much. Let's enjoy the rest of the work day. And I'm pleased for all that you've done for me. Thank you so much. And bye-bye, everybody. Mr. Adikanku, do you have a question? Mr. Adikanku, your hand is up. Are you there? Do you have a question? We're already signing out.
Okay, yeah, sorry, OJ.
Yes.
Thank you for this presentation. I just want to request or ask, these documents, can you put them together for us?
No, certainly. We're going to upload it on our YouTube and share the link for everybody to view it. It's available for viewership. Yes. Yes.
Okay, so we can get the material.
No, it's going to be there on the YouTube now. Okay, the material itself.
Yes.
It is proprietary in a way, but you can see it on the... Okay, you know what? I know what to do, but the YouTube is there. I know what to do, whether to drop it on a platform or something. This material,
yes.
No problem.
Okay.
No problem.
All right.
We can drop on the material
right,
and all of that. We know what to do.
All right. Okay. Thank you. Thank you, sir.
Thank you. Yeah, thank you, Mr. K. We'll drop the link on the platform too. Thank you. Okay, thank you, everyone. Thank you. Bye for now.